Well, good morning, everybody. Welcome to our session, SBA 7A Lending, General Overview. My name is Ute Westphal. I'm your moderator for the session, and I'm excited for us to join Chris McDonald with Harvest Bank. And we also have a second speaker, and that is Eric Bacon. Eric is Vice President with SummerCore. So we have today in the session 2 for 1. We have two great presenters in one session. A little bit of housekeeping. If you would like to ask a question or make a comment, please use the chat room. If you would like to speak, you can do that. Please raise your hand and we will call on you. We will break in between a little bit so we can have a conversation, maybe answer some questions that you have. This is an interactive session and we love the audience participation. Be so kind and mute your microphone when you are not speaking so we can reduce the background noise a little bit. I would also like to mention that this is being recorded and the recording will be made accessible to you after the conference. So nothing is lost. All the information will still be there for you after the conference. And with that, Chris McDonald, stage is all yours. Please take it away. And after Chris, we have Eric Bacon do the second part with SummerCore.
All right, thank you very much, Uta, and appreciate the warm introduction and very glad to be here and to have the opportunity to talk with everybody. Again, I'm Chris McDonald with an organization called Harvest Small Business Finance. I was connected to the organizers through Andrew Fogarty with a Greater Southwest Development Corporation, who I worked with in the past couple of years on some just more challenging commercial real estate loans. And that's kind of our focus here at Harvest. We're a non-bank SBA lender. I happen to be based in Chicago, but we're headquartered in Orange County, California, and lend all across the nation. And our niche is kind of doing some of the more challenging commercial real estate mortgages for small and mid-sized companies. Just our niche, knowing that we have comfort in the fact that we have SBA guarantees and tangible collateral like real estate. It just gives us an opportunity to be more aggressive on top of the fact that we're a non-bank lender too. So anyway, here to talk about 7A lending. After I present, Eric Bacon, our co-presenter, will discuss 504 lending. And feel free to reach out anytime on chat with any questions you have. I'll try to break periodically for questions too. So to start here, slide. There we go. I'm kind of new to this PowerPoint stuff on Zoom, so bear with me. But so to start, who is the SBA? I think most of you know who the SBA is, but in case there's anybody who's not as familiar, the SBA is a U.S. government agency that provides financial support to entrepreneurs and small businesses. Congress created the SBA with the Small Business Act of 1953, and the SBA's function verbatim is to aid, counsel, assist, and protect interests of small business concerns, preserve free competitive enterprise, and to maintain and strengthen the overall economy of the nation. So that's the official function. There's four groups within the SBA. There's providing access to capital, which is what we're here to talk about. It's pretty much financing for small businesses, entrepreneurial development. Many of you folks are here today. The SBA provides free counseling and training to new business owners. Government contracting. The SBA sets goals with other federal departments to award contracts to small businesses, and SBA advocacy. The organization reviews congressional legislation, testifies on behalf of small businesses, and assesses the impact of regulatory burden on small businesses. So pretty straightforward stuff. So going on to the next slide, what is an SBA loan? So a common misconception is that 7A loans are lent directly from the SBA. They're actually not. The SBA doesn't lend money directly to small businesses. Instead, the SBA sets guidelines for loans made by partnering lenders like Harvest or bank SBA lenders. So what happens is banks and other SBA lenders actually lend the money directly themselves, and it's guaranteed by the SBA up to 85%. And what needs to take place is SBA lenders need to adhere to SBA underwriting guidelines. There's a long policy, probably a few hundred pages, and so we need to make our loans in coordination with the SBA's policy. Some lenders are what are known as preferred SBA lenders, and then there's SBA lenders that need to get approval directly with the SBA. So as a preferred lender, we're allowed to approve our loans in-house. Harvest, we're a preferred lender, and otherwise these lenders are getting direct approval from the SBA. And when you're lending yourself in-house, you have to be especially careful that we're adhering to SBA underwriting guidelines. Otherwise we tend to get our hands slapped. But in essence, the SBA guarantee allows lending money easier for lenders. So for example, say a lender, we lend a $500,000 loan. For whatever reason, we have to liquidate that asset. It goes into foreclosure. We end up losing $100,000. If the SBA has a 75% guarantee, our loss is then only $25,000 because the SBA, in simple terms, just reimburse us for that 75%. So hope that makes sense. Types of SBA loans, SBA 7A loans, which we're here to talk about. There's a variety of uses for that, which I'll explain later. SBA 504 loans, Eric's going to talk about that. That's long-term fixed rate financing, mainly for real estate and equipment, but again, I'll let Eric touch on that a little bit later. And then microloans, which is providing $50,000 or less to help businesses start up and expand. Any questions before we move on? No. Okay, thank you. All right, so benefits. What are the benefits to small business owners? It provides, like we mentioned, access to capital that wouldn't otherwise be available for non-conventional clients or credits like startups, business acquisitions, gas stations, car washes, restaurants, gyms, hotels. These are the types of businesses and property types that conventional lenders tend to stay away from. For example, if banks see it as, if they ever have to liquidate a gas station or car wash, it's such a special use that it's just that much more difficult to liquidate and get your money dollar for dollar for. Another benefit is a lower required equity contribution. So in cases where financing is being used to purchase real estate or say equipment or even a business acquisition, instead of maybe something like 20-25% down like most conventional lenders would require, we can allow equity contribution of a minimum of 10%. So saves quite a bit of money. We can also allow for longer term amortization, which equates to lower monthly payments for business owners. So just as an example, if somebody has a real estate loan, typically that's amortized over 20 years maximum at conventional lenders, whereas for an SBA loan we can amortize that over 25 years, so it provides a little bit more cushion. Equipment loan, for example, instead of 5 or 7 year amortization, we can go up to 10-year amortization, which saves a nice chunk of change for business owners. All right, so now the 7A loan program, what can it be used for? It can be used for working capital. So for example, supporting the cost of hiring new employees, buying more inventory, supporting accounts receivable if the business just had their sales just ramped up quickly and they need to bridge that gap in the working capital cycle. It can be used to finance that. It can be used to purchase equipment, machinery, furniture and fixtures, supplies and materials, purchase of real estate and land, like I'd mentioned, construction of new buildings or renovations to an existing building. And this one is key for 7A lending, acquisition of an existing business. This is probably the biggest difference between the 7A and 504 lending program. Um, when conventional lenders typically see a loan request to buy a business, first thing that goes off in their mind is, well, what's the collateral? There's nothing really to sell except possibly the business, but a lot of times businesses that aren't quite mid-market businesses, they don't really sell for that high of a value, especially if they've gone downhill. So banks tend to stay away from doing that. Whereas utilizing the SBA 7A program, that's a common use of proceeds for financing is acquiring businesses. And then last, refinancing existing debt. That can particularly be helpful, like I mentioned before, if you want to stretch out the amortization to lower monthly payments. All right, and then what are some of the main SBA 7A loan types? There's two main types. One is the standard SBA 7A loan. It's a max loan amount of $5 million. The SBA turnaround time is typically anywhere from 5 to 10 days. And the guarantee percentage is 85% for loans up to $150,000 and 75% for loans greater than $150,000. Next is SBA Express loan, which is a max loan amount of $500,000. Turnaround time is within 36 hours, and the SBA guarantee is 50%. So the key difference between the two is the benefit to the business owner with going with the Express program is as long as their loan amount, requested loan amount, fits within that $500,000, they can get a faster turnaround time. And that being said, going back to my point of having preferred lenders and non-preferred SBA lenders. For preferred lenders, that turnaround time doesn't necessarily matter as much because either way, a lender needs to approve their loan in-house. So with us at Harvest, for example, not having to go directly to the SBA for approval, the difference in time doesn't matter all that much. But it's a substantial difference for any SBA lenders who don't have their what's known as a PLP, preferred SBA license. Any questions before I move on?
So far, so good. If anybody has a question, either unmute yourself or raise your hand, whatever you prefer. If the question doesn't quite fit what Chris is talking about at the moment, just place it in the chat room and we will bring it out when it fits. So please do not hesitate and participate.
All right, so moving on to SBA 7A loan program terms. So our payment is typically monthly payments of principal and interest for non-real estate loans. So that could be equipment loans, working capital loans, business acquisition loans. That'll be for a maximum term of 10 years, fully amortized. For real estate-based loans, so loans secured by properties that the business occupies, that'll be a maximum term of 25 years, fully amortized. And then one thing I wanted to note is for dual purpose, for example, if there's $1 million loan, $600,000 of which was used to purchase the real estate and $400,000 was used to acquire the business. If it can be demonstrated that at least 51% of the proceeds for a given loan is used for real estate purposes, you can actually benefit from utilizing the full 25-year term of the loan. So it's substantially lower payments. Interest rate is fixed or variable. It really depends on the lender. But in any case, the max that can be charged, I wanted to list this below, for loan terms of less than 7 years, the maximum interest rate would be prime plus 2.25%. Currently, that's 5.5%. Maybe a little bit higher than conventional lenders, but still not too bad. Loan terms of greater than 7 years, the maximum interest rate is prime plus 2.75%. So that's currently 6%. And then rates are higher for SBA loans less than $50,000, ranges from 3.25% to 4.75% over prime. So little bit higher, but doesn't impact business owners as much at that loan size. So SBA guarantee fees, 7A loans of 150,000 or less are charged 2% of what's known as the guaranteed portion. So for example, if we're looking at $100,000 loan times a 75% guarantee, that's a mistake. That should actually be 85%. But anyway, times the 2%, looking at a loan fee of just over $1,500. Not too bad. 7A loans, $150,000 to $700,000. We're looking at a guarantee fee of 3% of the guaranteed portion. So it's another example. Take a $500,000 loan times the 75% SBA guarantee times the 3%. Looking at a loan fee of $11,250. 7A loans, $700,000 to the max of $5 million. It's a range from 3.5% to 3.75% of the guaranteed portion. So, for example, $1 million loan times a 75% guarantee times a 3.5% is $26,250. So you can see, as with the larger loan sizes, the fees are higher. But the good news is guarantee fees can be financed into the loan. And then even better news for the next couple months through September 30th, with the new incentives provided by the small business incentive plan through the SBA. SBA guarantee fees are waived for all new loans approved by September 30th. And they also qualify for 3 months of essentially subsidized payments that business owners are no longer responsible for. So if you have anybody who is looking to get an SBA loan, definitely good to get them in now, because SBA lenders pipelines are ramping up pretty quickly, and turnaround time is getting a little bit slower. So moving on. So one thing I want to talk about here is in the cases where there's asset purchases, there's a particular equity requirement, like I mentioned, that 10% minimum figure. Again, that's based on each lender, but typically it's a minimum requirement of 10%. And this is cases where it's a property purchase or business acquisition. Wanted to run through allowable sources of equity. So number one, the easiest is just cash that isn't borrowed. So for example, cash that people have in their personal bank accounts, or cash that's in the business, or maybe a related company that the business owner may have. Sorry, I lost my train of thought here. Oh, another is can be a gift from a friend or family member, as long as they provide written communication that says it's a gift, and the recipient of the gift, the business owner, is not responsible for payment whatsoever. And then in either case, whether it's a gift from a family member or friend, or it's personal cash, one thing that's important to know is kind of similar to when you purchase a home, you're getting a personal home mortgage. You also have to be in SBA loan purchase transactions. You also have to be able to show that that particular cash was seasoned for at least a couple months. So what we usually collect are bank statements just for the last 2 months, whether it's personal, business. It could be combined if that's the case. But you should be prepared to present those or explain that to your client that that's going to be necessary. Other sources of equity requirement that's allowable is cash that's borrowed through a personal loan to the business. So for example, an advance on a home equity line of credit. Say you have equity in your home, you take out a HELOC advance on that, say $50,000, $100,000, whatever that may be. And then essentially you're lending that money to the business. You'll have, you can establish, a note. There's templates you can find online to keep it simple, but there wants to be documentation regarding that, just to make sure it's in good terms with the SBA's policy. And then the last option is what's known as standby debt, and this can include seller financing. And what standby means is it's debt that it's an agreement that we would look at that doesn't allow payment from the business to whomever issued the standby debt. So, for example, if it's the seller wouldn't be able to collect payment, interest or principal until the SBA loan is paid off. So sometimes it can be a sticky point, especially with sellers. But sometimes if there's no other option, that's the way it is. So eligibility factors for 7A. Businesses need to be independently owned and operated. They need to be for-profit entities, so no churches or other nonprofit organizations. They need to be based in the USA or its territories. And on this note, businesses owned by permanent resident aliens are in fact eligible. We just need to get the documentation for that. And then businesses need to be of a certain size. So the two main factors are a maximum tangible net worth less than 15 million and average net income less than 5 million. And if you don't qualify based on those factors, all the much more power to you. You're doing pretty well, but we don't typically see that too often. And then last is just to be able to demonstrate the need for requested financing. For the most part, all the businesses that come to me, we're always able to demonstrate a need. So I've never really run into a circumstance that's prevented us from moving forward. But, in the case where, for example, there's a guy who has, say, $10 million in personal cash and is looking for a $300,000 SBA loan, he easily has his own personal liquidity to, finance whatever needs to get financed himself. And a situation like that, he probably wouldn't qualify. But again, all the much more power to him.
Chris, can we throw in a question?
Yeah, absolutely.
Something we are battling, especially since COVID last year. So not all businesses are set up that they have an FEI number. So are their ITIN numbers accessible? Allowable?
I'm not. When it comes to specific documentation like that, I'm not as well versed, but you're asking if they have just a regular EIN number?
Tax identification number instead of.
Yes. Yeah, that would work. Yeah. Mm-hmm.
Thank you.
Yeah, absolutely. Right. So then moving on. This is kind of the basic loan decision criteria, also known as the 5 C's. I'm sure people heard about this in their business classes. So to start here, we have capital, equity and liquidity. So equity we already talked about, making sure that we're documenting the fact that people have the amount of equity they need to inject into a given purchase. But then on top of that, for example, if somebody had say $50,000 in liquidity and their down payment on a purchase was $50,000, lender would say, they don't really have that much liquidity to operate the business or step in if there's a hiccup and kind of take over the loan payments if necessary. So that's one thing to take into consideration. Lenders typically, based on a loan size or based on a particular industry or what market conditions may be, they want to make sure that borrowers have a certain amount of liquidity, whether personal or in the business, or at least have access to, maybe they own their home free and clear, or there's a lot of equity in their home and they have a home equity line that's not drawn that they could tap into if ever necessary. That's also a nice plus. Collateral is the second C here. Whenever lenders are evaluating a loan request, we look at collateral as the secondary source of repayment. So obviously we want to get appraisal reports. A lot of times we'll get environmental reports as well. And then, what are the conditions? There needs to be a market for the business, and the business should be able to show that they can withstand any increased competition or any barriers to entry. Character is always really big. What's the owner's business experience? Maybe if they don't have that much business experience, are they going to hire a manager to help out? Maybe the manager previously managed the same business. kind of get an idea on that. What's the educational background? We're going to pull credit reports and background checks. If somebody shows that they didn't pay their home mortgage for multiple times in a row, it's gonna it'll raise a flag. At Harvest we can work with borrowers that have lower credit scores, but a lot of times we'll see circumstances where somebody missed maybe a month or two on their mortgage payment or a car payment. Maybe there was something that happened. There was an illness or some kind of oversight that we can explain away. But if there's consistent neglect to paying obligations, it will raise a flag. And then last here is capacity. Can the business repay the debt? Lenders like to look at historical financials, tax returns to see how the business has done. If it's a startup business, or if say the last year or two for an existing business didn't cash flow, we're going to want to see some solid projections that are well thought through to show that the business, based on certain changes or whatever that may be, that they will be able to confidently service the proposed debt obligations. Loan application items. Just kind of run through these quickly. Application form, which includes a credit report consent, business plan, particularly for new businesses. These are required. And then projections. I'm going to touch on these within the next slide. But projections are always very important, especially for businesses like I mentioned who are startups or had maybe a rough year or two prior to the requested financing. Interim financial statements. These are generally a balance sheet and an income statement. If we have historical tax returns, that's great, that's required. But for example, here we are in August 2021. If we just have a 2020 tax return, we don't know what's taken place in the last 7-8 months. So typically lenders want to see, actually, not that they want to, they have to see interim financial statements, usually within the past 30 to 90 days. Business debt schedule, we'll want to get an idea of what existing debt is out there, maybe debt that we're either paying off or that's going to remain on the company's balance sheet. 3 years of personal tax returns, a personal financial statement that illustrates business owners' personal assets and liabilities. Let's see. Oh, and that's what's known as 4506 tax transcripts. This is just a one-page document that allows us to request from the IRS transcripts of previously filed tax returns, just to make sure that the tax returns that were provided to us match up with what was also provided to the IRS. And then a couple more, what's known as the SBA Form 1919, just kind of touches on, it's official SBA form, touches on eligibility factors, loan request, company information, things like that. And then if there's a purchase involved for a business or property, we'll want to see a purchase agreement, if applicable. And then to move on here, we're going to discuss projections for 7A. So typically 2 years are usually required, with the first year broken out monthly. That's not necessary for year 2, but we do want to see 2 years of projections. Projections, they may not be required based on the lender. If a company's doing just fine, they've been able to show that they can pay their requested debt obligations based on historicals. Typically, they don't need projections, but that's a lot of times always discretionary based on the lender. In the projections, we typically don't need to see a balance sheet, but the income statement / profit and loss is what we really want to see how the business is going to cash flow. And the main components to projections are revenue, cost of goods sold, and operating costs like employee salaries, rent expense, utilities, all the kind of the overhead for the business.
Is there a difference between an existing business applying for 7A and a startup business that does not have a history, a financial history?
Yeah.
2 years, 3 years, what do you request?
So for an existing business,
Mm-hmm.
so existing business will Harvest, for example, will want to see the last 3 years of tax returns. If the business was started maybe a couple, less than 2 years ago, we'll get, whatever tax returns are available. But that wouldn't, for us at least, that wouldn't be technically, startup in our concern, as long as the last fiscal year end cash flows, we're okay with that. But yeah, there's a difference in terms of the scrutiny lenders will place into an existing business versus a startup business. So for a startup, maybe the lender will want more equity into into any sort of property they're buying or equipment or leasehold improvements they may be putting into a restaurant, for example. Maybe they'll probably want to see the owners have more liquidity because it's more questionable as to the business's success. But yes, there would be more scrutiny looking at a startup business versus an existing business. Yeah.
Thank you.
Mm-hmm. So moving on, I wanted, regarding projections, and I just have, I think, a couple more slides here. But I wanted to just touch on revenue projections, just because this is kind of the main driver for the business. And a lot of times I get projections that, aren't really well thought out. So to kind of go through these, in calculating revenue projections, specific assumptions are very key. So for example, for a restaurant, instead of just kind of putting on there, we're going to generate, $20,000 monthly, lenders like to see, well, let's get kind of more nitty gritty on detail. What's going to be the average meal price times the number of tables filled, times the average seats, times table turns. It doesn't have to be that exactly, but just some specific information that we can hang our hat on. For product sales, what's the average unit price times the expected number of units sold. It's good to break out by category, not every line item, but for restaurants, break out food sales, alcohol sales, product sales, break out by any particular various category there may be, and then this way you can also break out what the expected cost of goods sold is by category to kind of match that up. And then it's important to explain variances. So, any increases in sales or decreases, explain what's driving that. Are there any, price changes, new marketing, new salespeople that are being hired? Be sure to discuss that. And then last, account for any seasonality. So if it's a, ice cream shop that's projecting on a monthly basis, obviously during, December, January, sales are probably going to not be as high as they are in the summertime. And then last slide here is just general tips on projections. Businesses don't have to be firmly held to projections, but definitely be reasonable. Sometimes I'll get projections from clients who the last 3-5 years they've showed $100,000 in profit. And then their projected periods, all of a sudden they're showing, $800 to $1 million in profit. It's just, let's just be realistic. That kind of stuff isn't really going to happen. And then the more, well thought out and reasonable they are, it really adds more credibility to any underwriter who may be reviewing the credit. If they see somebody who's just kind of, throwing out unreasonable numbers, even if the more realistic numbers are lower, it's still just better overall because it improves the credibility in the eye of whoever is approving the given loan. Also important to scale expenses with revenue. So for example, if it's being detailed that revenue is expected to increase by adding on new sales staff, then obviously we want to see reciprocal increase in employee salaries and wages within the operating costs. and just, detail every line item. A lot of times it's pretty self-explanatory if, say for example, employee wages are going to be consistent from last year to the future year, even though it's the same. Maybe just detail, hey, we have this many employees at an average salary of X, and that's how we arrived at this figure. Just so it's detailed, it just, again, adds more credibility to what you're doing. And then last is just every projection is unique to each business. So don't try to go off of somebody else's, projection template that they provided. A lot of times, starting with, your own or your client's own historical financials, that's a great way to start because those are the exact costs that they're incurring. And you can, utilize that as a starting point to project on further. With that is it. Any questions? No, doesn't sound like it.
I'm sorry, I couldn't unmute myself for some reason. Gotta love technology. Okay, audience, this is your chance to clarify experiences that you had, questions that you have to, in the future, serve our clients in a way that they get an okay for their loan. So please take the opportunity, ask a professional, ask Chris. You can unmute yourself and start talking. You can add something in the chat room, for example, like Todd did. Any idea of what % of loans are startups? Chris, can you answer that? Yeah.
Any idea of loans that are startups? That's a difficult question for me because at Harvest we specifically focus on commercial real estate financing. So a lot of our clients are existing businesses or that are looking to refinance their existing mortgage or purchase a new property. So I actually don't see startups too often. There are lenders who will will focus specifically more on startup businesses. My guess is it could be anywhere from, for those type lenders, anywhere from maybe 20 to 30% of all their applications. So there's quite a bit of startups that are getting financed by SBA lenders. For me personally, I haven't had as much experience. I maybe get maybe 1 or 2% of my loans are startup requests, but there are definitely lenders that focus on that more heavily.
We have 2 follow-up questions for this topic. One is, what are the chances for a startup to purchase real estate with a 504 loan?
I'm gonna let Eric answer that question because he's the 504 guru. He's with SummerCore, one of the main CDCs in Illinois. And Eric, do you wanna answer that question?
Sorry, could you say that again real quick?
The question was, is it possible for a startup to obtain a 504 loan to purchase real estate?
Yes.
Is that even an option?
Yes, that's an option, and I'll get into it as well. The equity contribution would just be a little greater. Rather than 10% down, it'd be 15%. So it's possible, just a little more is required.
It sounds like we've kind of moved a little too fast, so I assume we're getting there. One other question for Chris was, how much detail do you like to see in projections?
So the detail with projections is, really just having every line item, detailed with a specific assumption. So what I and sometimes I'll help my borrowers put projections together. So I'll just make sure I kind of break out, revenue by category. For operating expenses, what I usually do is I just kind of take the biggest operating expenses and focus on those, so that maybe the top, maybe 7 to 10 operating expenses and provide just more basic detail on that versus revenue. For example, revenue is the kind of the main driver to the business's success. So I tend to focus more on revenue, but nominal costs like whether it's professional fees or just any nominal expense, I'll just kind of bucket that into just other operating expenses. Otherwise, it can get a little tedious to get every single little expense item. But that's kind of how I usually go about it, and that typically is great for what the SBA wants to see.
Thank you, Chris. I have to assume, Kevin, that answered your question. Christina is asking, from your perspective as a banker, how do you define a startup?
Startup is any I think technically, and Eric, correct me if I'm wrong, but any business that is less than 2 years old is considered a startup. It can really depend on the lender's perspective. At Harvest, if a business is literally just starting up and hasn't even collected $1 of revenue, absolutely, that's going to be a startup. But if there's for us at least, I can't speak for every lender, but for us at least, if there's maybe a year at least of some revenue generation, and we feel like the business is kind of quickly stabilized, while it's may technically still be a startup in the SBA's eyes, we'll kind of utilize that as a strength of the business, kind of prioritize that over a business that's just brand new and hasn't even collected $1 in revenue. If that makes sense.
I would say it does. I assume, Christina, that answered your question. And it sounds to me like you two are ready to make the switch. We're moving over to Eric. Is that correct?
Sounds great. I will thank you, everybody. Appreciate the questions. I'm going to hit stop share and let Eric take over.
So Eric, if you want to hit share screen. There you are.
All right, everyone can see that.
All good, Kev. I'm sorry.
Perfect.
I'm all good, Eric. Take it away.
Thank you. Cool. Well, I'm Eric Bacon with SummerCore. We are what's called a CDC, Certified Development Company. So we're certified by the SBA to promote, originate, underwrite, and service the SBA 504 loan program. So same thing as Chris. If you have any questions, shoot them in the chat, and we will get to them as soon as we can. So who is SummerCore? We were founded in 1992. We our mission is to utilize the SBA 504 program to create jobs, grow businesses, and make an impactful investment in communities. So we are generally rated top 25 in the nation as far as new 504 originations in each year. So here's the kind of guidepost that I'm going to try to hit and keep it relatively brief for everybody here. But the 504 rules and terms, what the 504 would be structured like. It's for purchase, and then I'm going to go over a refi, the refi part of the program, which has some new exciting changes as of last week, and then a couple sample projects to kind of get everyone's mind kind of jogging in that direction. So what is the 504? The 504 is a lending option for small businesses to buy, expand, or refinance major fixed assets. So that's commercial real estate, equipment, and machinery. As far as commercial real estate goes, construction, renovations is included, or just buying an existing building. The 504 mission is to create jobs or at least retain jobs, develop communities, and then also focus on minority, women-owned, and veteran-owned businesses in the process. It functions as a public-private partnership. There's three, in every 504 loan, there's kind of three players. SummerCore we partner with another bank or lender, such as Harvest and Chris, and then there's the borrower. So there's kind of just rather than just the bank and the borrower, there's Summercore will take a piece of that loan, and I will explain those incentives shortly. So who can use the 504 program? A couple things: you must be a for-profit business, and then what does the SBA consider a small business? That would be anyone under 15 million in tangible net worth, and then under 5 million the prior 2 years of tax return. So that's pretty substantial. That's, might not be a small business in a lot of people's minds. So it's a pretty substantial size project that we could potentially be working on. And then another major qualifying factor is that it must be owner occupied as far as the real estate that would be financing goes. So for an existing building, that's 51%. And for a new construction building, that is 60% day one occupancy by the business, with the intention of having 80% or more down the road. What industries? Chris hit on this a little bit, but pretty much as long as it's federally legal business, it's something that we can lend to. Manufacturing, healthcare, franchises, restaurants. As long as it's, like I said, as long as it's federally legal, it's something we can take a look at. Here's kind of the highlights of the incentives. First is the rate, below market rates, means lower monthly payment. So right now, our rate is about 2.8% fixed for 25 years on the portion of the loan that the SBA would lend. So it's an awesome rate. It's been below 4 since 2019. It's been below 3, it seems like, for the last 6 to 12 months as well. That rate is determined by the SBA directly. So there's no negotiation, there's no kind of haggling. It's just the SBA sets out the rate and that's what it is. But it will be below market. That's one of the pillars of the program. The other major incentive is less money down. So we could qualify a lot of businesses for 90% financing. So only 10% down of the total project cost is pretty substantial, rather than a regular commercial or conventional loan could be 20, 25, 30% down. So on $1 million building purchase, that adds up. And the final nice incentive for the borrower is that it's a long-term fixed rate. So no balloon payment after year 10. It's a 20 or 25 year fully amortizing loan. And here's the rates as of July. So as I mentioned, kind of a 2.8 25-year fixed rate, and there's also some other options. The 20 or 25-year option is primarily for real estate, and then the 10-year option is primarily for equipment. So here's the structure. I mentioned the 10% down option. So with those pie charts there, a normal conventional bank loan might be 25% down, 75% loan comes from the bank. But with the 504 and only 10%, potentially only 10% down, that's a substantial savings. So here for a $2 million kind of mock project, that's a $300,000 difference in what would have to be paid out of pocket. So what's eligible with the 504 to be financed? As I mentioned, the land and building, either acquisition, construction, renovations, equipment, fixtures, certain soft costs. But what this is the primary difference between the 7A that Chris talked about is the 504. We can't finance a lot of these other kind of intangible items or items that would have a kind of lack of collateral, working capital, inventory, goodwill, business acquisition, vehicles or rolling stock. So that's probably the primary difference. 504 is looking to finance kind of hard fixed assets that are used by that business. So here's an example structure. Just an easy round numbers. We used $1 million. Purchasing a $1 million building with a 50, 40, 10 structure. So as you can see there on the bottom left, the sources of funds: 50% bank, 40% SBA, and 10% equity. And then on the right there, you can see the associated fees. And then bottom right, you can see what that estimated monthly payment would look like. I don't think I touched on this earlier, but as far, I mentioned kind of we need a bank or lending partner. And yeah, Chris obviously is a great resource and could definitely team up. But if you currently have a relationship, and all banks and all lenders, for the most part, can use this program. So it's not there's nothing necessarily no certification or anything like that. There definitely are some banks that embrace SBA lending more than others, but just wanted to mention that. Here's an example project for one that we did in 2019, I believe. So it was a company called Ink Factory. They were renting in the city of Chicago, and then they found a building that they wanted to buy and renovate. And as you can see from the outside of the building, it's actually a mixed use building. So they have some rental income on the second floor there. And as long as they're over that 51% owner occupancy mark, it's eligible. So this one, it was kind of nice. They're able to get a lower fixed rate with the 504, and then also get some tenant income as well to help make that monthly payment. So now, if anyone has any questions, that's kind of the general program, and as far as it relates to purchase. And now I'm going to kind of break off and go into the refi aspect of it. So now might be
We had one question that is to both of you, actually, to Chris and Eric. And the question was from Rodney. Are both the 7A and 504 overutilized or underutilized?
That's a good question. I think both programs I have right now are seeing kind of a record demand for a few reasons. With COVID, banks were kind of a little more hesitant to lend out, so having an SBA guarantee as part of a project was a nice kind of add-on. And then the second, I think, reason for that is with PPP and EIDL, now it seems almost every borrower and bank has some familiarity and some experience with an SBA loan, where maybe 2 years ago it wasn't an option presented at the table. Now everybody kind of has an experience with it and is interested in learning about it. So I think the last year, I think the last 12 months, I think has kind of had record demand. So I think we're both, Chris and I might be a little biased and say it's underutilized, but it's definitely been in high demand this year.
And you have the total right to do that, of course, from your perspective. Of course, it's underutilized. But if any point you two want to make a comment about how a business advisor at the SBDC can actually help a borrower or help you, I think it's a team effort here. If you see anything in your process where you say, well, here is where we need the advisor, here is where we feel an advisor can make a difference for a successful application. If you want to go into that a little bit, depending on what you're talking right now, please tell us what we can do to make your life easier and the client successful in a loan application.
Yeah, that's a great question. I think Chris touched on it a little bit. Is as far as kind of every business owner is going to be in a little bit of a different part of their timeline, whether they're been doing it for 20 years and it's a family business or it's a startup. So I think a big part is kind of organization, and that cuts down on any sort of confusion and timing, and helps our timeline as well on the underwriting and review and approval side. I think Chris also mentioned this, to piggyback off that, is a lot of borrowers do struggle with the projections, and how we got to certain projections. I think that could be definitely an area to assist.
All right. Anybody have any comments or questions?
Great. Then I'll keep going into the refinance structure. So the refi is a program that was rolled out in 2016. as a permanent addition to the 504. I don't think it's had as great a success as the SBA intended, but it still can be a great option, especially with where rates are today. So just as your general, refinance would go, basically the bank would take a portion of the loan and the SBA would take a portion of the loan. We can provide cash out, but we are limited based on the appraised value. We can do a 90% loan to value if there's no cash out involved, or up to an 85% loan to value if cash out the borrower would like to include the cash out. The cash out portion can be 20% of the appraised value of the property. So that's what I mean, kind of what we're limited. And then the SBA would like the cash out funds to be used for operating expenses. So salaries, rent, utilities, inventory, that sort of short-term debt, that sort of stuff. They don't want that to be used for personal expenses or buying another business or capital expenditures. So it's just something that we have to mention in our underwriting. I did mention at the beginning that there have been some changes to the refinance, and it actually heavily relates to the 7A program. First major one is that we used to have to wait 2 years for a loan to season before we could potentially refinance it. That has been changed to 6 months. So if anyone on the call has a building, or just bought a building, or has a client that bought a building, and they did a conventional loan or a 7A loan, maybe inside that 2-year mark, we could potentially take a look at it. But the primary improvement to the program is that we can now refi government guaranteed debt. So that means we can now refinance an old 504 loan or an old 7A loan. There's a couple strings attached to that, as far as we have to show a certain amount of savings, and the lender has to basically agree that they cannot modify the loan, the original terms of the loan. So there's some strings attached, and we're still working through that. This change was announced on last Thursday, so just a week ago today. And we are, and see at the top there, we are hosting a webinar on August the 11th to go over those changes that might potentially apply to you. So go check out our website, summerco.com. It will be there to register. And here's a example structure. So the assumptions here on the top left: they own a $1 million appraised value property with $600,000 of debt on it currently, and they have a cash out request of $200,000, which is 20% of the appraised value. So they're maxing out that cash out possibility. And then you see in the bottom left the sources of funds. The bank and the SBA loan would actually be split down the middle. And then the equity would be what the equity remaining in the building is. So the $1 million minus 600 minus the 200 of added debt. And then same goes on the right side for rate. Here's an example project. Movie theater refinance. We were able to do cash outs, and with a long-term fixed rate, we're still able to lower the monthly payment. Oh, and one other thing to mention, as far as it goes with the refinance, is the same rules apply for the original use of proceeds that apply for the 504 purchase. So whatever debt we'd be refining would have to have originally been used to purchase the building or build the building. And then those same owner-occupied requirements would apply. So if you have any questions on that, or a specific situation, feel free to reach out to me and we can discuss. And here's a great slide. I forgot this was in here as far as it relates to the question earlier about the over or underutilized. Here's the last 5 years of 504 loan approvals across the country. This is not just Summercore, unfortunately. But across the country, you can see, a large upward trend, peaking in this case over the last 12 months. So September 2020 marked the largest funding in the 34-year program history. So over almost 1,500 loans across the country were funded, which was double the previous record, which is pretty substantial. And then here's the last slide I have. Just shows you kind of the wide range of opportunities, dollar size projects, industries that we can potentially, that you could use 504 or 7A financing for. So we offer financing anywhere in the state of Illinois. But you can see here there's grocery, plumbing, assisted living, restaurant, hotels, sports facilities. So just a very wide range. I like this slide because sometimes people might have heard that an SBA loan can only be used for a restaurant, or can only be used for a certain industry or certain segment. But that's not the case. As I mentioned earlier, pretty much as long as it's federally legal, we can take a look at it. And the same thing goes for the dollars. I might have refreshed over it earlier, but we can participate in projects of 20 million. It's just the SBA portion cannot exceed 5 million, and the SBA portion can go as low as 50,000. So that would essentially be about $125,000 total purchase. So as high as that, as low as 125, 150,000 on the smaller end. So same thing goes for that. Sometimes people make an assumption that an SBA loan can only be for a $50,000 purchase, or the opposite. So I think that is, here's the summer core team. I think that's all I have. Let me know if there's any other questions.
So one of the questions we had here was, do you do a good job at helping lenders understand it is an insurance program versus direct lending?
Chris, I think that's more for the 7A.
I think so, yes. Oh, yeah, he corrected. He meant borrowers, of course. So do you help borrowers to understand? I think the question goes into, does the borrower actually have a say in which program they would like to prefer? How do you as Harvest Bank put a package together, how a loan package could look?
Sure. Yeah, that I think I understand. So for example, whether somebody would go the 504 route versus 7A. So yeah, so for us, if it's a case where it's a borrower that maybe historically cash flows, and we're not reliant on projected income. If it's pretty kind of straight down the line, we'll probably take that 504. So we would do the first mortgage. We partner up with Eric to do the 504 debenture. Now, we usually utilize our 7A product for some of the more challenging circumstances, like maybe the business was in a turnaround situation. Things are kind of trending up the way, the right way, but historically, if you look at a company, it just doesn't look so good, and that's something that most conventional lenders just struggle with and can't do. So for us, with the 7A guarantee, we tend to get more aggressive. So usually, the more challenging the loan request is, the more likely we're going to take that 7A. If there's adverse credit circumstances, like maybe there's an existing tax lien, or there's kind of some other credit blemishes, whether personal, we'll probably want to take that 7A also, just because we tend to get more aggressive utilizing our 7A product.
Thank you. Well, Rodney, I hope that answered your question. I hope that we understood the question correctly. I want to go back to our question from earlier, Eric. How adventurous is it for a startup to actually start with buying a building? And the reason why we come across this issue more often since COVID is what is happening in the commercial in the commercial real estate world at the moment. So there are more startups now that have an opportunity to not even start with a lease and battling a landlord and a long 7-year personal guarantee lease. They say at that point, why don't I just buy the building? How are their chances to do that with the 504?
Yeah, it's definitely possible. I mean, any lender is going to tell you a startup's going to be more difficult because there's no proven, track record to rely on in our underwriting. So at that point, it comes down to the personal guarantor or personal guarantors. Who's the owners of the company? What does their financial situation look like? Is there any outside income? What does their liquidity look like? So it's definitely possible, but more difficult just because it's projection. I've never seen projections that look bad, so we kind of take those at a little bit of a discount, right? It's nobody's going into business thinking they're going to lose money.
There was a great comment. I've never seen projections that look bad. Well, that kind of makes sense, but I have to assume that the projections need to be justifiable. They need to be explainable, and they need to make sense within the industry. So I do think that predictions cannot just come out of the blue sky. They have to be realistic, right?
Exactly, and whether that's based off a previous business or a competitor or another business we're part of, we just exactly like to see those assumptions and kind of how we got to those numbers.
Other questions? Don, I thought you unmuted yourself. I thought you wanted to.
Yeah, I did, and I was reconsidering whether I wanted to ask it, but I guess I will. This has become, I don't know about common, but enough for me to take notice in our market. There have been a couple of opportunities, and it was the same kind of for our business, where if you were able to purchase the building rather than having to lease the same building, those dollars are remarkably different. I mean, I did a study for our building. I could probably rent our building for 3 or 4 times what our loan payment was. Those situations don't come up a lot, but if you see that in somebody's projections, and they actually say, if I lease it, here's what it's going to cost me. If I buy it, it's going to reduce my ongoing costs a lot. How much would that factor into it?
Yeah, I mean, that as we're looking at kind of what makes sense for that business, it definitely would be worthwhile looking at. The tough part about underwriting and kind of getting an approval from our loan committee and getting approval from the SBA is just if there is a lease, it's not necessarily going to be lent by the bank or by us. So it definitely makes sense. It's like as far as like a project viability standpoint, but I'm not sure if that would be kind of an overriding swaying factor when we're kind of looking at it. But definitely worth, if that is the case, definitely worth mentioning, and especially in the projections and business plan.
Any other questions? We have a large audience. I'm surprised how mute this large audience is. Usually we are way more chatty. I'm going to give it a moment.
Uta, I had one of these yesterday. I credit the quality of the speakers with the lack of questions. You're just covering everything so thoroughly.
That is probably a good comment and probably correct for the session. One last question for both of you. What would you say is the most value that a business advisor can bring to the process? Where do you see where we come in with value, and what can we do to make the process better for the client, for the borrower, as well as for you?
So I can touch on that. Yeah, great question. So, so the first two things I thought of is helping the business owner put together, a solid business plan, helping them with the projections, particularly for the business owners who maybe aren't as sophisticated. They really need the hand holding to put those together. Like I mentioned, I kind of help my borrowers do that kind of thing, but I think most of the time lenders aren't really doing that for the client and expect them to be able to do that. And for maybe less sophisticated or just maybe not as experienced, they just they really don't know with both the business plan and projections how to really make it look good and realistic. So I think that's probably the biggest help you can contribute with.
Eric,
Yeah, I would add to that is just being able to present multiple options. I think just information and knowledge and about the lending program. A lot of our borrowers, this is their first time buying a building, or some of them it's the first time taking on any sort of debt. So just being able to kind of present multiple options, whether there is a conventional bank option, an SBA 7A or an SBA 504, or there's a million other programs. Just being able to present a few different options, I think would be very helpful.
well, Chris and Eric, do you have any closing remarks, any comments that you want to leave with us?
I guess for me, I just say if there's ever financing that you're not sure where to place it, feel free to run it past me at Harvest. While we do commercial real estate, there's still a variety of other partner lenders that we know and have relationships with. So I'm always happy to point you in the right direction to get something done. So if we can't do it, I'll help you find somebody who can.
Yeah, same. That's exactly what I was going to say.
Well, this was great. Thank you so much, Chris McDonald from McDonald. I shouldn't skip your D at the end. From Harvest Bank, and Eric Bacon from Summercore. Thank you so much for putting this together and helping us understand the process better. Thanks for taking time out of your probably busy schedules to be with us this morning. So thanks again, everybody. Thank you to the audience for questions and comments in the chat room. This was great. And I hope I see all of you back at the next session. So we have some time for lunch. I give you back 15 minutes of your day. So you have a little bit more time to have lunch. And I will see probably some of you back at our 2 o'clock next webinars. Thanks again, Chris and Eric.
Thank you for having us join. It was a pleasure being here and talking with everybody. So really appreciate it.
Yeah, thank you so much.
Absolutely.
Thanks, everyone.
Bye, everybody.